Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. As always, I'm your host, Seth Bradley. What if the fastest way to build wealth as an entrepreneur isn't starting a business, it's buying one? And even taking it a step further, it's not with cash, it's not with debt, it's not even with the help of a team of expensive attorneys, but if you do need one, reach out. It is with deal structure, creative deal structure. Today's guest has bought and sold over 200 companies and taken over 100 companies public and advised over 300 deals across 12 countries, including the US. And he's been invited to the Buckingham Palace and to the British Houses of Parliament to advise on business and enterprise. He's a Wall Street Journal best-selling author, and he's been doing this since before acquisition entrepreneurship was even a buzzword. He's been doing it since he was 15 years old, folks. So if you raise capital, if you run a business, if you want to buy a business, if you want to understand how force multipliers work and understand how real wealth is built through private company ownership and acquisition, this is the conversation you've been waiting for. Let's go. What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Today on Raise the Bar, we've got my man, Jeremy Harbour, entrepreneur, deal maker, founder of the Harbour Club, and CEO of Unity Group. Jeremy is widely regarded as the world's leading expert on small business M&A. He's bought and sold over 200 companies, probably more than that by now, pioneered a model for taking small businesses public, and built a global community of over 1,000 M&A professionals. His books, including the Wall Street Journal bestseller, Go Do Deals, have changed the way entrepreneurs think about wealth creation. Jeremy, welcome to the show, my man.
Thank you for having me, Seth.
Absolutely, brother. Tell the audience where you're tuning in from, because that's interesting by itself.
Yeah, so I'm in a place called Annecy. It's in the French Alps.
Very cool, man. All the way on the other side of the globe from me in San Diego here.
Yeah, absolutely.
Well, look, you know, we've got lots of entrepreneurs out there that are listening, and this question is easy for most folks, but hard for us. So when a stranger asks you on the street what you do tell them?
That is a really good question. Do you know what? I used to come to, when I was about 18 years old, I used to come to New York every couple of weeks, and you used to have these landing cards on the plane you had to fill out, and they had the most ridiculous questions like, have you ever been a terrorist and stuff like this, you know? It was, and so for a Brit, this is really hard for us to fill out with a straight face. We just have sarcasm in our DNA, you know? So how do you answer this without getting arrested by the TSA at the other end? But one of the questions was, what do you do? And you know what? For me, it was quite profound because I didn't know how to answer it. You know, entrepreneur, well, that's like a really broad brush. That could cover all sorts of nefarious things, couldn't it? I mean, and then you have, like author. Well, I'm not really an author. I've written books, but that wouldn't be my kind of classification. So it then kind of struck me that the answer we actually give is like this really convoluted kind of mess of what we've done in the past, whereas actually we can probably reverse engineer it and position it from what we want to do in the future, and start from there. So I guess you could come out and say, like, I'm an astronaut, I just haven't been to space yet, you know, and really really kind of focus on what you want to do. But to be honest, most of the time when I'm out in social settings, I kind of swerve the question because I don't want to get into a 1 hour conversation with somebody about what I do. So, I mean, literally the last person that asked me, because it was a day ago up in the mountains, And they said, hey, what they said, oh, where you're from? And I said, oh, I'm from Dubai. And they said, what do you do in Dubai? And I said, as little as possible. Just because it swerves the next 1 hour of my life. And I guess that's very different because when I was younger, and I was, craving business and I was looking for deals and I was networking like crazy with everyone I ever met, then, I either positioned my favorites were positioning myself as an investor. Because if you just say, I'm an investor, then the next drill down question would be what you invest in. So I specialize in small to medium sized businesses in this geography, in this rough industry or whatever it is. That opens the door to all sorts of more interesting conversations. Not necessarily that you're going to invest in them, but people like to know investors. It carries social capital with it to have those people in your kind of Rolodex. So that always worked quite well for me. Otherwise, just I buy and sell companies. That tends to pique people's interest in terms of, oh, really? What kind of companies? It's kind of almost treating the company as the product rather than the products that the companies sell. Sorry, it's a long answer to a short question.
There you go. That's exactly what I expected. That's exactly what I expected. Is we'll kind of go around a little bit, and then at the end of the thing, you're like, "All right, cool, right?"
Especially but no, honestly, I mean, it sounds really bizarre, but for the most part, I'm not trying to get sucked into conversations where I end up doing a deal with someone, because otherwise, every conversation turns into some sort of deal opportunity, and you have to kind of keep some focus. Otherwise, you just end up running down 500 rabbit holes.
For sure. So you started at an extraordinarily young age. I read somewhere that you left school when you were 14. Is that right? To start a business?
Yeah,
that's wild.
Yeah, left school at 15 to continue running a business I'd already been running for a couple of years. And I mean, both my parents were the first to go to college in their families, so it was kind of a big deal for me not to. But I managed to get away with it. I had a careers guidance counselor that kind of sold them on it. So that was I only found that out many years later, but that was quite useful. And I screwed it up and went. I had to come. I left home and was running this business, living in my own apartment when I was I left when I was 17 and was living in my own apartment. And then when I was 19, had to come back with my tail between my legs and kind of beg for kind of come back and sleep on the sofa kind of thing, because they'd already moved to a smaller house by then. It was like, hey, he's gone. So,
yeah. Did you just continue your entrepreneurial journey after that? I mean, we don't really talk about the failures all the time, but did you keep going?
There's no. If it stops you, it's failure. If it doesn't stop you, it's lessons, it's learnings, and everything is about learnings. Every day is a school day. So, this just gave me a platform to get it right next time. And I think there were, tons of lessons I got from that first experience. I mean, the first one was really just about dealing with staff and dealing with overheads, like, I had a premises and all this kind of stuff. This was all completely new to me at the time. And of course, first time you sign a lease, you get the shiniest, spankiest premises you can find. And you don't really look at how long the lease is and how much the rent is. You just think everything's doable. And when you're hiring staff, you're perhaps too slow to get rid of people that you should get rid of. And you tend to believe the stuff they tell you. And most of the time, what they're telling you is not exactly as it is. So, you learn those lessons at the pointy end of business, and you get it right the next time around. But obviously, if you don't get it right quick enough, then that particular business ceases to function and you have to do something else. And so, I had kind of 3 months of, behaving like a fucking wounded animal, and then I got on with it. So it was back on the horse and off you go.
Yeah, for sure, man. What are some of those early lessons learned early on? How were you able to kind of overcome that and keep going?
Yeah, I mean, look, the biggest one was that the tightrope you feel like you're walking is only 6 inches off the ground. So it feels like a terrifying, thing, but actually when you slip, it's not that far. It doesn't hurt. There's nothing that's going to kill you. So knowing that, would I have run faster? Probably. So, if you know that falling over doesn't hurt, why not go a bit quicker? A lot of the kind of risk mitigation stuff is mitigating risk that wasn't really real. So that was a big lesson. And then I guess, each business that I got involved in, there was a new kind of lesson. And I guess coming into the deal making side of things, buying my first company was just the biggest lesson, because I had grinded away as an entrepreneur, playing around with team and how you be a great leader and how you motivate people and how you get people to kind of magnify the work that you do. And then you focus on marketing and all the different channels and ways that you can get people to stick their hands up. And then you focus on sales, how you get those people to buy their products from you. And all of my effort was in those three kind of areas. And then I bought a business, and I bought it with no money down. It grew me by a year's worth of sales in an afternoon. And it was basically an epiphany. I'd been running the marathon. I only needed to run the last 10 yards and I still got a medal. And so, I bought a business that was 13 years old, 13, years of blood, sweat and years from that business owner. I didn't have to put any capital into it. I didn't have to hire any salespeople, do any marketing, deal with any, team members running off stealing customers and all this kind of stuff. And so for me, it was just an epiphany that there was a different way to grow a business. It wasn't that you could forget the other stuff. It was just a whole other area that I'd never seen before. It was like somebody pulled the curtain a little bit, and I realized there's this fourth way of doing things.
Yeah, that's a big concept that you really push, right? Is to acquire or to buy a business as opposed to starting one from scratch. I think that that's a big concept for people, because a lot of times people come up with these ideas, and ideas aren't worth anything until you put them into operation, you execute.
Of course.
Right? But it's much harder to start a business than for buying one. But there's also risks involved in buying one. Maybe just kind of give us your thoughts and overviews on why it's better to buy as opposed to start one from scratch.
Yeah, I mean, look, the first 3 years of any business is pure effort and burn. There's no upside really from the first 3 years. You're going to be pouring money in, you're going to be pouring your time in, you're going to be pouring your resources in. Now, when you're young, you have a bunch of those 3-year segments that you can commit to things. But as you get older, those 3-year segments potentially become a little bit more valuable. If you think about it, until you're 20 years old, you're still figuring shit out. From 60 to 80, you're kind of the other end of the spectrum. So the bit in between is like 40 years. So 3 years is like 8%, of your useful time on the planet that you're devoting to figuring out if this thing's going to work or not. Whereas you can pick up a business that's already operational, within a very short space of time, like a week or two, and you've already got staff, you've already got customers, you've already got an office, a website, et cetera, et cetera. Now, you talked about risk. This is the key when you're buying owner-managed small businesses, is risk mitigation. So you basically want to create, or you want to identify deals that have an asymmetric risk profile. So there's no downside. You've covered your downside in the deal structure, and all you've got room for is upside. So it's kind of heads you win, tails you don't lose. So your downside is mitigated. You have some opportunity costs, some time costs, but you have a lot more of that in a startup. If you buy a business and it's shit, you can close it down and walk away within 3 to 6 months. You don't have to push it for 3 years to see if it's going to work, and then have endless conversations with your wife about whether you throw the towel in or give up on it or go back and get a job or whatever. You can figure it out pretty quickly. And I mean, even if you have a great idea in the shower for an app or a startup or whatever it is, there's probably another business out there that services a similar client base that you could buy and then get them to develop that app or that idea and market it to their customers without having the pain of starting from zero. I think it solves a lot of things. I think also the biggest area that I found this advantageous is in growing existing businesses, because buying competitors, buying other businesses into existing companies, it just solves so many problems. It solves the scale problem. Businesses need to get to a certain scale to create some kind of robustness and resilience. And it's very hard to break through the glass ceiling to get to that scale, whereas an acquisition can help you kind of leap there a bit quicker. It's a great way of solving team issues, finding good people. The best place to find good people working in businesses like yours is to find them working in businesses like yours. So they're already there, they're proven, they can do the job. So integrating, those great team members through acquisition can be really good. Succession planning, again, same idea, but at C-suite level. So you can go on and be non-executive in your own business. There's a number of advantages in doing M&A that can really help business owners as well.
Yeah. How do you help people kind of identify those? Well, first of all, how do you help them identify, what kind of business that they would potentially want to buy? Because it's a little bit different, right? Than I'm in the shower and I'm thinking about, this app or this software, this thing that could just change the world. And man, this is incredible. Let me go find a software engineer to co-found this with me, something like that. And it's like you're off to the races, and chances of success are very, very, very slim.
Yeah.
They've kind of ideated and came up with that. But now we're kind of talking about, the world is your oyster. Everything's open. There's lots of businesses you can buy. Is this just kind of a general entrepreneurial person that you help, and they're just looking to see what is the best opportunity, or how do you help them identify that?
Yeah, there's loads of different applications. So, look, the one that you just talked about, which is this idea of a startup idea, just think about who the common customer is. So let's say your startup was for, Airbnb owners to, have an app that does the inventory for their Airbnbs or whatever it is, So then you might want to buy something like a property management company, a lettings agent, even a real estate agent, maybe something like this, where you could then, that's got revenue, it's got profits. They could invest some of that revenue, some of that profits in then developing this app. And then the first people that they can offer it to is their own clients within there. And you can still be the evangelistic entrepreneur running around telling everybody about how great this app is, but you've actually got a vehicle now that's going to deliver that to people, and you're not going to have this go raise 300 grand from your Aunt Nellie, spend 6 months developing the technology, then figure out it doesn't really work properly and have to start again, or do it in a different platform, or do it on a different basis or whatever. So you can do all of this from within a business that you've acquired. So that's the kind of idea one. The other one is just buying a business instead of starting one, which is quite common for people because and then they're a bit more agnostic about what they would go into. Now, theoretically, if you can ooze credibility to the business owner, you can buy anything in any sector. But in most people's cases, it's better if they buy something they understand and that they know about. So, think about the mountain of value that you're standing on now. What's your history? What have you done? What have you done in your past? What experiences do you have? What industries do you know really well? And focus on those areas, because those are the business owners you're going to be able to create the most rapport and credibility with, because you'll understand what it is that you're talking about. If you have a business already, then you just need to think about, do you want to buy more businesses the same, so like a horizontal acquisition, or do you want to do vertical integration? So are you looking for, if you were, let's say, a lettings agent, are you looking for that real estate agent, the property management company, the M&E company, the HVAC company, etc., that you can vertically integrate with your business? Or are you looking to solve a problem? So are you looking for geographical expansion? Are you looking for talent acquisition? Are you looking for just more customers? What is it that you're trying to solve with the acquisition? And then in all of those cases, the first thing is figuring out, is the research. So the most common mistake is people go try and find businesses for sale in those sectors. And that's the worst place to start. You almost want the opposite. So take all the businesses that are for sale, exclude them, and just target the rest of them. So if you know you want the letting agents in San Diego, just go on Yell.com and find all the letting agents in San Diego. Make a list of them all. And then reach out to the owners of those businesses through LinkedIn. You can buy email lists, maybe use Hoovers, to get their data and write to them all. But basically, reach out to all of those people and just suggest that you're looking at, investing or acquiring companies in their space, and that you'd love to have a chat with them and pick their brains about the industry and what their thoughts are on, the challenges and opportunities that face the industry. So kind of blow a bit of smoke up their arse, appeal to their ego that you're reaching out to them as an expert, and then start having conversations with all these business owners. And after you've spoken to 5 or 6 of them, you'll start to see the stars aligning. Like, okay, this guy wants to retire. this guy would definitely sell if the offer was right. This guy wants to run it forever, but maybe he'd be a good manager if I put a group together. He could run the thing. This team's really young and hungry. This one's really old and tired. So you'll start to build a picture of the all of the opportunities, and there'll be some that are ready now, some that are ready in 6 months, some that are ready in 3 years, and so on. And you just work your little patch.
I love that. I love that kind of Trojan horse approach there, and you're kind of ideating with them, and then you're describing like what you're looking for, and it sounds a little bit like what they have, and then bam,
hey, shit, maybe we should do this together.
Exactly. And I love that it's like, okay, let's look for the businesses that you're looking for that are not for sale, because that is certainly counterintuitive, right? Most people go to, like, in the US, you go to bizbuysell.com. That's where you would go. And then,
unfortunately,
but those folks looking.
Those guys have already picked out what leather color the Mercedes is going to be done in, and they've been shopping the beach houses in San Diego next to you. It's,
Yeah, for sure. You talked a lot about asymmetric risk and why buying a business versus starting one from scratch helps you find that, helps you reduce that risk and find, mitigate your risk. I think the biggest risk when you're buying something is probably capital out of pocket, or getting debt, or taking out a huge SBA loan or whatever it might be. How do you help mitigate that when you identify a business that you do want to acquire?
Yeah, absolutely. And you're absolutely right. And basically, I think what people don't understand, or the biggest thing people don't understand, is the fact that there really aren't many buyers for small businesses. So if you look at all the businesses in the world, it's like a pyramid. There's a bunch of big ones at the top, millions of small ones at the bottom. If you look at the universe of buyers, it's like that. There's loads of people at the top that can buy all these big ones. There is no one at the bottom. It's you at the bottom. Now, they will want money. They will ask you for a check up front. If you give it to them, you're the one that's born every day. Basically, if you don't give it to them, you can still buy their business. Of course, they will want it, but what you need to do is you need to share the risk with them. So in other words, if they want to get $1 million for their business, they're going to have to work with you to get that $1 million. And that's going to be achieved through, some deferred payments, some earn out, some, structuring of the transaction so that they get what they want and you get what you want. And if they work with you, they will get it. And if they don't, they'll be for sale forever and they'll never find a buyer. They'll be on bizbuysell.com for 2 years, 3 years, and they won't find that buyer. So, whether that's them retaining certain assets until certain amounts of money have been paid, or, there's 15 different deal structures I go through in my community for doing these kind of transactions. We've done transactions up to 200 million euros, which is about 250 million US dollars. That's unusual, but we do lots and lots of deals in the 10 to 20 million dollar range. So these are not small businesses. They're not bankrupt businesses. They're not distressed. They are motivated. They need a transaction to happen. But you can structure deals on a win-win basis with the other party to reduce your risk and to balance the risk with the vendor.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Yeah, out of those 15 creative deal structures, what do you think are one or two of the most creative or most useful, I guess, kind of as you go through those?
So the most useful is probably what we call a WIBO, which is a work-in buyout, and this is where instead of trying to buy the entire business on 100% deferred payment off the bat, which is quite hard to do because you have to build insane amounts of trust and rapport with the business owner. I mean, you almost have to be confidence trickster levels of communication skills in order to close those kind of deals. I'm not saying that it's a confidence trick by any means, but you really have to have extreme rapport to do it. So I've seen it being done, but it's not something that's easy to do. So what the WIBO does, it breaks it down into parts. So what you do is initially you take a stake in the business, typically 20 to 30%, in exchange for adding a load of value. Now, there's a big list of things that we run through that you can use to add value. But, if you're amazing at marketing, sorting out their marketing. If you're amazing at finance, sorting out their finance. If you're a great consultant or coach, it might be whatever you deliver through your consultancy or your coaching, but for equity instead of for fees. Now, quite often these people are charging some retainer as well. So it's a retainer with an equity kicker. But it basically gives you a foot in the door, allows you to do a full due diligence on the company because you're working closely with them for, say, 3 to 6 months on a particular project, and gives them an opportunity to get to know you really well, because ultimately they're going to give their business to somebody they like, know, and trust. And then there's many different tactics as to how you go and buy the rest of the business, but quite a common one is you advertise it on bizbuysell.com or businessesforsale.com. So that if it sells, you're going to get 30% because you're a 30% shareholder. They're going to get the other 70%. But what will happen during that process is they'll get a bunch of people reach out to them and offer to buy it on a fully deferred basis. So I'm going to pay you over the next 5 years using the company's own profits. And at that point, you can pivot the conversation to say, well, look, rather than give it to them, why don't you give it to me on the same basis? And of course, you're in pole position versus a complete stranger to execute that deal. And they've kind of tested the market and realized that's the best offer that they're going to get because that's the offer everybody's making. So you're then primed to take it over. So you kind of have a 3-month kind of consulting period where you're working with them, probably a 3-month marketing period where you're making them realize that the only deal is a deferred deal, and then probably a further kind of 3 to 6 months to close the other 70% of the business. So within 12 months, you own 100% of a company. Now, what's interesting is if you went and did an SBA loan to buy that same company, you'd have to stick 20% of the value of the business in day one in cash. And it would probably still take you 12 months. With the DD, with the lawyers on all sides, you'd also have to fund the lawyers for the bank and for yourself. You'd be out of pocket for quite a bit up front, and then you're on the hook with the bank with a personal guarantee, betting your house, all the usual stuff. So instead of doing a leverage buyout, we do a leverage business owner. So it's still an LBO, but we're leveraging the business owner to get the business. So that's the simple one. I think you asked for the most creative as well. A really creative one we have is one called extra bonds, exchange traded acquisition bonds, and these are really cool in roll-up strategies. So effectively, instead of offering deferred payments, vendor finance, which people always are concerned about the capacity for repayment, etc. You actually issue a listed bond. So it's listed on a stock exchange. The extra stands for exchange traded acquisition bond. So you list a bond on the stock exchange. Now, instead of selling the bond for cash and giving them the cash, you actually give them the bond in exchange for their shares. So you use the bond like a currency. And they hold the bond until maturity. They get a coupon, so they get an interest payment on it. And you can have a buyback program so that from the profits of the company, you're regularly buying back the bonds. And so they get to hold the bonds for the entire duration. It's tier 1 debt over the whole group. So they effectively have a highly secured position in your roll-up. And then you buy them back out of the bonds over a shorter period of time. But if you don't buy them back out of the bonds, they're still tier 1 debt holders and they can hold it till maturity. The great thing is you don't have to compete with other bonds. You have to compete with what they would do with the money. So you pay a lower percentage interest. So typically, if you had to sell a bond, you might need to pay 10% coupon, 10% interest. But with an extra bond, you probably only have to give 5 because you're comparing it to them sticking it into a CD or paying off a mortgage or something like this. Plus, there's no distribution cost. So typically, if you issue a bond the traditional way, you spend quite a bit of money selling the bond, typically about 10% of the value of the issue in selling it, and that's if you can sell it at all. Whereas when you issue it as a currency, there's no distribution cost because you're giving it straight to the business owner. So as creative structures go, it's pretty cool. You can issue quite large amounts of bonds against relatively small companies. So we had a company doing 3 million of EBIT, and we issued 50 million in bonds. So that gives you quite an acquisition war chest to go to town with and buy other businesses.
That's incredible. I mean, this is straight fire, because I think most people out there, when they think about buying a business, they're like, all right, well, I've either got to come up with a bunch of cash, take it out of savings and buy it, or I've got to go to the bank and get a loan, or maybe I'm going to get really creative and get some kind of seller finance piece, and that's about as far as it goes. So yeah, this is awesome.
Yeah, I mean, when I bought my first company, so I was lucky. I was in an industry that was really acquisitive. So in the telecoms industry back in the 1990s, there were thousands of companies, and the only way to grow, because everyone had a telephone, the only way to grow was to buy another telephone company. So everybody was acquisitive. So I had this unhealthy amount of pitches, from people trying to buy my business. And so I learned a lot from just being in that industry at that point in history. And what was fascinating was I was exactly where you are then, which is I need a ton of money. I need the bank to lend me a ton of money. I need a VC behind me, a private equity company behind me. I need a rich uncle. I need, and plus I need a lawyer. I need an accountant. I need to know what the fuck I'm doing. All of this, these are all the reasons why I can't, besides I can't pay the fucking salaries at the end of the month. So why am I thinking about buying a business, And then I had all these meetings with these people that were coming to buy my business. And I realized they're the same as me. They don't know what the fuck they're talking about. They don't have any money. They can't borrow money from the banks. They're just trying to get really creative with how do we get you out of your business and into ours, And if you're motivated, that solution is quite compelling, because there are not a lot of natural buyers for businesses at that level. You have to get to a reasonable size before even trade buyers can kick in, because their cost of doing a deal is quite high. With all the due diligence and everything else. As soon as you surround yourself with advisors, you can't play in the kind of lower ends of the pool anymore, and all the businesses are in the lower end of the pool. Like half the economy is sub 5 million revenue.
Right. So now that you've acquired one of these businesses, you've used really creative deal structuring and able to acquire it within your group, or your students, like, do you teach them how to optimize this business? Is there a lot of that kind of training? Because I've seen people buy businesses have no business being an entrepreneur at all, right? So exactly. They need some help, right?
Yeah. So look, what we focus on is what we call financial engineering, and it's really things that you can do to the business that it's not about increasing sales, improving marketing, or any of those kind of things. It's more, how do you address the accounts and the balance sheet and the cash flow in a way that enhances the business. So there's a lot of that kind of optimization stuff. Now, of course, if people have skills around marketing and sales, that's great. But those are kind of the cherry on the cake. It's not the be all and end all. And then, of course, we love roll-ups. So I talked about the pyramids of businesses that exist and the buyers. Well, if you can move up the scale pyramid, then there's more buyers. So you have a more sellable business. And if you have more buyers than sellers, then the valuation also increases exponentially. So, we've done some free advertising for bizbuysell.com so far on this interview. So if you go to the bizbuysell.com annual report, you'll be able to see the average prices businesses sell for. Now, they show the earnings ratios for businesses sub 1 million and above 1 million. And if you take like an engineering company, sub 1 million, it's about 1.2 times earnings. Above 1 million, it's about 1.8 times earnings. And then if you went to like above 5 million, you probably get to 3 or 4 times earnings. And if you went above 10 million, you probably get to 7 or 8 times earnings. Well, that size is really only 2 or 3 small ones stuck together. So if you can go up that food chain, you could be buying businesses at 1.8 times earnings that are worth 8 times earnings just by being part of your group. So there's a huge delta, a huge increase just in scale. You haven't touched anything else. All you've done is stuck them under the same holding company. So before you optimize, before you get rid of people, before you exploit the synergies, just scale is a driver. And I often say this to acquisition entrepreneurs. You can invest a year, pissing around inside a company to save a few dollars or make a few dollars, or you could spend a year buying 3 more. And actually investing in the time in the 3 more has way more impact on shareholder value. And then the optimization and the synergies to be extracted, that's the job of the teams in those businesses. So instead of you getting sucked in, because I used to suffer with this as an entrepreneur, you want to interfere with everything. It's in our DNA. So basically, if you instead of being head of interfering, be head of M&A. Go buy more shit and let the people in the business optimize and find the opportunities. So if you incentivize them to make $1 or save $1, and you put them all in the same room, apart from the fact turkeys don't vote for Christmas, so they're not going to sack themselves, they will optimize a lot of stuff in the business. And trust me, when they do it, it's a great idea. When it's your idea, it's fucking terrible.
Got it. So when you're looking at evaluating businesses to acquire and teaching other people how to do it, you're not looking for failing businesses or things that you can turn around or things that are completely mismanaged. You're trying to find really good, solid businesses so that you can just stack them and get those equity multipliers.
Yeah, I mean, there's a lot of different strategies. We do have people in the community that focus only on distressed, actually, and they love those bankrupt companies. Most people only go after the distressed and bankrupt stuff as a way of adding customers to an existing business. So as a build strategy, to effectively asset strip a business and just take the customers and stick them into your business is a great, because you can buy these businesses for $1. You move the customers into your business and you liquidate what's left. So you chapter 7 the rest, and it's gone. And that can be a really effective way of adding tons of customers without lots of marketing expenditure. But generally speaking, let's find profitable, well-run, slightly less suicidal business owners that we can do deals with. So
Awesome, man. Let's start moving towards the exit, right? And preparing for some sort of M&A yourself. You've already acquired the businesses, you've rolled them up. Perhaps you've optimized your management. You've put really good business together. I saw that you've taken over 100 companies public, which is wild to even say out loud. How does a business owner go from running, let's say, like a $1 or $2 million company, because a lot of folks can kind of maybe get to that level, to being listed on some public exchange, and then why would they want to? Because to me that sounds way up here. That sounds like
So I guess there's a couple of things. The first one is you have to choose: do you want to exit or do you want to grow? And if you want to exit, just exit, sell it. Businesses are quite hard to sell, so you want to be in the top 1% of businesses that are for sale. So get the data room right, get all the information right. There's a real having good curb appeal is really important when you're selling a business. That idea of how you do anything is how you do everything is really important. So if they ask you a question, it has to be there in the data room ready for them, or you can get it to them within 30 minutes. If you can't, the deal's dead. I mean, really, you need to have everything at your fingertips, everything ready, everything there. Really great information memorandum, really great due diligence Dropbox. Also, if you can pre-arrange some finance for them, that's amazing. So reach out to some banks, financial institutions, maybe an SBA funder, and get some kind of pre-approval or offer letter that basically says, we'd lend money against this business up to this amount. So you're just basically removing all the obstacles for them and making it super easy for them to do a deal with you. So that's if you're selling. If you're looking to grow, there's a really well-trodden path at corporate level, which is to go public and use the public markets to grow your business. And when you have a public company, you can use your public stock to buy more companies. You can issue those bonds that I talked about very easily. You can do that as a private company, but it's much easier once you're a public company. You have enormous credibility. It's much easier to approach acquisition targets, talent, customers. You can win government contracts, tender for corporate contracts, all that kind of stuff much more easily when you're a public company. So it's a really good platform to grow. And if you're in any doubt, pick up the Forbes list and look at the top 100 people. They all took their companies public and used them as a platform to grow, from Bernard Arnault to Jeff Bezos to Elon Musk, Mark Zuckerberg, Bill Gates, Warren Buffett. I mean, the list just goes on and on and on and on. And if you delve far enough down the list, you find the real estate guy. So, going public and using it as a platform for growth is by far and away the best trodden path for creating wealth. But it's often not used at the SME end of the spectrum as much, because in the SME end of the spectrum, people assume you go public to raise money or to exit. And it's a very expensive, clumsy way of raising money. And it's a really dumb way to exit, because what you want to do is attract other people to come and buy shares or stock in your company. And why would they buy it from someone that's exiting? If you don't believe in your own business, why should they? So the key thing is the management have to stick around for the whole thing. So it's a 5-year plus plan when you take your company public. But in that 5 years plus, you can 10x the value of a company in the public markets. So if you're worth 3 million, 5 years you'll be worth 30.
And you can do that with what I would call a smaller company, 1, 2,
yeah,
$3
as long as you've got a pathway
company.
to not be a smaller company. And in fact, we're working with a number of US companies at the moment. We've just taken one US company public in Europe, and we've got 2 more that we're doing right now. Where basically we re-headquarter them in Ireland, which was very popular during Obama's time. There was a ton of big US companies that re-headquartered in Ireland. So we set up an Irish holdco. We stick the American company underneath it. We take that public in Europe, where it's about 1% of the cost to go public, and the compliance is much more simple as well. We then use the European markets as a growth area. So we help you do M&A. We help you grow the business. And when you're big enough, we can come back to the US. So when you're 1-2 billion market cap, then you can come back and list on the US, either as a cross listing from Ireland, or an ADR, an American Deposit Receipt, which is where you list a bit of the company in the US. It's actually how most of the big European companies are listed, like LVMH, and those guys are all ADRs. Or you can literally just file a S1, I think it is, and you come list. So you can do that kind of direct listing from the European market. So you've got options to come back to the US when you're big enough. But there's no point being a small cap in the US.
That's incredible, man. This question might be a little harder for you because you started so early on at 15. But to wrap this thing up, in a parallel universe, tell me about a different version of Jeremy Harbour.
God, don't know. People always ask me, what would you do differently? And do you know what? Nothing. You are the sum of your experiences, and I've had good and bad and gone through some real shitty times in my life, but they're all part of where I am now. And I'm obviously extremely, happy with who I am and where I am now. I have a beautiful family. I live an amazing lifestyle. Doing deals has given me enormous freedom to go and do stuff. But I cannot imagine a universe where I wasn't an entrepreneur. It was just, I was picking flowers from my mum's garden, sticking them in jam jars and selling them outside the front door of the house when I was 7. So I don't know, it was just in me. So I can't imagine a universe where I wasn't an entrepreneur, but look, there are a million sliding doors moments, or a million moments where you can turn left or right, and I've gone down a lot of wrong turns in that career, and I'm 51 now, so it's a while. Bought my first company 30 years ago, so it's insane when I think of it in that on that basis, and I made a ton of mistakes and screwed a whole bunch of things up. But as I say, every one is a layer of learning, and all of them are so counterintuitive that you'd never figure it out without fucking it up. It's the only way. So I'm really glad I have that. I always say to people, I know 10% about M&A, and that's 9% more than everybody else. So it's puts me in a good position.
Amazing, brother. Amazing. Where can our listeners find out more about you, Jeremy?
Yeah, so look, hit me up on Instagram, harbour.jeremy. It's the one with the blue tick. If it doesn't have a blue tick and it's trying to sell you crypto, it's probably not me. And then if you want, you can also go to harbourclubevents.com. Harbour is spelled the British way, so it's Harbour. So go to harbourclubevents.com. And on there, you'll see a little button at the top that says free course. Just click on the free course. We'll send you an email every day for 21 days that will honestly take you through pretty much everything we've discussed on this call, but in a lot more detail with videos, with documents and all that stuff. So how to find opportunities, how to put deals together, what to do with them when you've got them. It's a really good little comprehensive course, and it's completely free.
Jeremy, you're the man. Appreciate you, brother. Thanks for coming on the show.
Cool. Thank you for having me.
All right, builders, that's a wrap on today's episode with Jeremy Harbour. If this conversation made you rethink about how you're building wealth, whether that's through deals, acquisitions, raising capital, going public, or even just unlocking the value that's already sitting inside your business, well, that's exactly what we're here for, and we're glad we can help. So do me a favor, leave a rating and review on Apple Podcasts or Spotify. That's how we keep attracting world-class guests like Jeremy and delivering conversations that actually raise the bar. If you want to find out more about me and what I've got going on, go to SethBradleyESQ.com and grab the Fund Founders Playbook. That'll really help you take the next step in your journey to capital raising, whether that's for a business or real estate. And we're always here to help you here at Raise Law. So check out the show notes, connect with Jeremy, find the Harbour Club, go to SethBradleyESQ.com. And as always, enjoy the journey and raise the bar. Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.